What's your assessment in terms of how we're set up heading into final 5 trading weeks of the year, and what that then will tell us about some of the momentum that we could see from markets in 2024?
Well, I think you nailed it when you hit the topic of renewed flows into the equity markets. In particular, we've seen a tremendous number of portfolio managers that had expressed relative caution. And I would actually highlight that the flows appear to be coming from institutional and registered investment advisors. There doesn't appear to be a component that's coming from individuals as much as it is people who had been relatively cautious in their portfolio construction are now being forced to cover their shorts. We see that as positive flows, even though that money is already in the market. It was simply sitting in cash or cash-like instruments. We've moved from an underinvested position to what increasingly looks like a potentially overinvested situation, exactly as you described in the February 2022 type framework. This doesn't feel like a renewed outbreak of optimism as much as a renewed outbreak of nihilism, in which people are simply saying, man, I don't know.
And what would you attribute kind of most of bears being out of their league to? Is it perhaps, and what we've heard at least coming into this week is that for anyone who's still calling for a recession, you're starting to sound like the boy who cried wolf. Is that the case here, or is there something else at play?
No, I think that's absolutely the case. And I think what we have seen broadly, you've seen Jim Chanos shut down Kinnikos. You've seen Dan Loeb announce that he stopped shorting. You've seen David Einhorn announce that he's going to stop shorting. Right? We've seen these behaviors over and over again as people have simply said, I can't understand what's driving markets higher. Most people that are in this situation will acknowledge that a lot of this is simply a function of mechanical flows that are either occurring due to passive investments or systematic and algorithmically driven strategies. There's very little thought that appears to be going in. We're seeing a market that's increasingly just dominated by these mechanical implementations.
So, Michael, how should, break this all down then for investors in terms of investors trying to position their portfolios heading into the new year? What should they be favoring?
Well, I think this is an interesting opportunity where thoughtful retail investors in many situations are at an advantage versus their peers in the institutional space. They don't actually have a required allocation. So if I give money to a credit manager, they're going to have to put it into credit. If I put money into a treasury fund manager, they're going to have to do it. Or if, like roughly 94% of Americans at this point, the vast majority of my retirement flows are going into something like a target date fund in which nobody's making an allocation. It's simply being applied in a proportion to what a historical model would suggest given my age. You have the chance to actually change that and be thoughtful about the extraordinary change in yields that has been created and reallocate portfolios in a thoughtful manner that meet your investment objectives rather than simply something that's tied to historical return profiles. So I would encourage people to take a look at the radical change that's occurred in interest rates over the past 18 months that the Federal Reserve has actually told us are unsustainable and designed to slow the economy. And yet, ironically, people have really not tried to change their allocations, particularly on the institutional side, because of the rigidities that are built into the system today.
To what extent have we already seen many of these short positions then betting against the market close out? And does that mean we're still anticipating some of that to come forward, thus kind of adding more fuel to a rally going into the year end?
Unfortunately, I actually think it plays in the opposite direction. There certainly can be an impact of a January type effect where we see bonuses and other components that are contributed to flows. But I think that there's some really important signals that are coming out of the marketplace. We've seen IBM move from a 401k match to a fixed income allocation. Now, that's obviously for IBM's benefit, but we're starting to see the rumbles of significant changes in portfolio construction and design to take advantage of the much higher interest rates that we currently have today. We're simultaneously seeing a market that is composed of the best of times for many of the largest stocks that are aggressively buying back their shares with the very high cash flow that's being generated by their super profitable businesses. And at the same time, if I look across the market in total, the median stock, the vast majority of stocks are actually down. The Russell 2000 equally weighted is down over 6% for the year. That feels completely incongruous with what we're actually seeing in market headlines about a raging bull market.